Adani Group companies continue to slide for a third straight session.
$6 billion gone in a day.
Short seller Hindenburg research accusing the conglomerate of share price manipulation and fraud.
Using shell companies to pump up the stock of Adani Enterprises.
The report is a malicious combination of selective misinformation, baseless and discredited allegations.
India's Adani Group says it's exploring legal action against a US short seller, Hindenburg Research.
He says Hindenburg is making an attack not just on the company, he's also making an attack on India and its growth ambitions.
The fundamentals of our company are very strong. We will continue to focus on a long-term value creation and growth.
Hi everybody, on 24th of January 2023, the Hindenburg report launched a direct torpedo against the Adani Group and it caused a havoc in the Indian capital markets. And like we saw, this had such an insane impact on the Adani stocks that 7 Adani companies lost more than $100 billion in market cap. And ever since this report has come out, the entire Indian public has been segregated into 2 extreme categories. While on one side people believed the report blindly and started bashing the Adani Group for pulling off a fraud, on the other side, people dismissed the Hindenburg report itself and labelled it as a direct attack on the Indian economy. So we decided to read both the documents as carefully as possible to help you understand both the Hindenburg report as well as the Adani Group's responses to the report. And after we put out all the arguments in front of you, it's completely up to you to decide who's right and who is wrong. But the best part is, regardless of who wins or loses, the one thing that's good about this drama is that it helps us capture our attention to teach you the most remarkable concepts in business. So in this episode today, let's do a deep dive and try to understand what are the most powerful arguments of Hindenburg against the Adani Group, what are Adani's responses to these arguments, and most importantly, what are the study materials to help you understand this Adani-Hindenburg saga better. This video is brought to you by thinkschool's Communication Masterclass course. People, if you love the way I tell stories and if you also want to learn how to present your ideas in the most powerful manner possible, come join my Communication Masterclass course. This is a 6 weeks course wherein I have designed special exercises to take you step by step from the beginner's level all the way up to the TEDx level presentation skill. And if you have any doubts while doing the course, I do live Q&A sessions on a weekly or bi-weekly basis and I will personally answer all of your questions to help you become a great presenter. So if this sounds useful to you and if you want to master the art of communication, use the link below and join our Communication Masterclass course. Chalo, let's start from the basics and understand why the hell is Hindenburg bothered about Adani so much and what do they gain from this information war? Well, as it turns out, Hindenburg is a financial research company that looks to find self-created or man-made issues and uses a method called short selling to make a profit by the fall of a company's stock prices. So if you're familiar with the concept of short selling, please skip to this timestamp. But if you're not, here's a very simple example to understand this concept. Let's say thinkschool is one of the listed companies in the Indian stock market with the stock price trading at 10,000 rupees a share. And Ayush is a super sharp investor who thinks that the price of thinkschool share is overvalued and it's going to fall drastically. So what Ayush would do is he would borrow 1 lakh shares of thinkschool for 30 days from Parsh. Who is Parsh? He is one of the shareholders of thinkschool. And the condition of this transaction is that after the loan tenure, Ayush has to return 1 lakh shares back to Parsh. And in return for this lending, Parsh would receive a commission of 0.21%. And this commission is based on a lot of factors like stock volatility, market conditions, financial indicators, etc. And this transaction would be mediated by a stockbroker who would again receive a commission to carry out this trade. So now Ayush has 1 lakh shares of thinkschool worth 10,000 rupees each. And now what he would do is he would rapidly start selling thinkschool shares at 9,000 rupees. So in total, he would sell shares worth 90 crore rupees. And when he sells 1 lakh shares at such a steep discount, the entire market will feel as if there's something terribly wrong about thinkschool stock. And soon enough, there'll be a panic in the market, whereby even other investors who bought thinkschool stock, they will start selling it in large numbers. And when this snowballing of panic happens, thinkschool stock price will come crashing down and will eventually touch 8,000 rupees in just a few weeks. But now, Ayush would cleverly buy back these shares at just 8,000 rupees. So when Ayush buys 1 lakh shares at 8,000 rupees, it would cost him only 80 crore rupees. So you see, while Ayush sold thinkschool shares for 90 crore rupees, he bought them back at just 80 crore rupees, eventually making a profit of 10 crore rupees. And then he would return these shares to Pash. This is how Ayush would make money through short selling, or as they say, by shorting thinkschool's stock. And just like that, even in this case, Hindenburg would have borrowed these stocks from a broker while Adani's stock price were extremely high, and they would have sold it in the market. And after that, when they came out with the report, when the stock prices came crashing down, now or a few weeks later, they would buy back these stocks. Eventually, they would make a profit. So regardless of whether these allegations are true or not, if the fear-mongering causes the stock to crash, which it did, Hindenburg would make a hefty profit. Now, is this illegal? Well, not really. Is this right or wrong? I don't know. But just because they are short selling, you cannot just ignore the Hindenburg report without actually reading it and understanding it. If this is very clear to you, let's try to understand the Hindenburg's allegations and Adani's responses to the same. Now we all know that Adani, who had a net worth of roughly $120 billion, he had gotten most of his wealth in the last 3 years. At the end of 2019, his net worth was around $20 billion. But the rest $100 billion got accumulated in the past 3 years itself. And this, according to Hindenburg, is largely through the appreciation of his stock prices in his group's 7 key listed companies. If you see, in the last 3 years itself, Adani Enterprises' stock price has shot up by 1,398%, gas has shot up by 2,121%, and green has shot up by 908%. So the question is, how on earth did Adani companies accumulate so much wealth, and what is the secret to their growth? Well, apart from their cutting-edge execution, one very critical factor for their growth has been their debt strategy. And this is one of the most important things that the Hindenburg report points out. So let's use a simple example to understand this. And by any chance, if you remember this example from our video that we made about 6 months back, please skip to this timestamp. If you don't, here's an oversimplified analogy to help you understand the Adani's debt strategy better. Let's say we have a listed company called Think Enterprises with a market cap of 10,000 crores, a revenue of 2,500 crores, and a net profit of 500 crores. And under this company, we have 3 more companies called Think Power, Think Infra, and Think Green. These 3 daughter companies are not listed yet, but they have a huge potential to scale in the next 10 years. Now you see, if Think Enterprises bags a tender to build a port that would cost 7,500 crores, Think Enterprises will have to reject it. Why? Because we do not have the profits to pay 7,500 crores. At the same time, the banks would hesitate to give us a loan of 7,500 crores with such low profits of just 500 crores. And the last way by which we could raise money would be by pledging our shares. As in, if my stake in the company is worth 7,500 crores, I would pledge 10% of my shares in the company worth 750 crores, and then the bank would do a risk analysis and give me a loan worth 350 crores. But in this case, to raise 7,500 crores, I can't pledge 80% of my stake and raise these loans, right? That would be ridiculous. But this is where a consultant designs an intricate framework to help me get these projects effortlessly. Firstly, we would decide to list all our daughter companies in the stock market, and because of the brand value of Think Enterprises, all the 3 companies would have a stellar IPO. So in the next 5 years, Think Green has a market cap of 100,000 crores, Think Power hits 10,000 crores, and Think Infra stands at 5,000 crores. And now, our shareholdings amount to 75,000 crores, 7,000 crores and 3,500 crores respectively. And now, if Think Infra wants to raise 7,500 crores, here's how they would do it. Firstly, it would raise 2,000 crores by projecting its profits. So if your company is generating 500 crores of profit, the banks would not mind lending you 2,000 crores because they know that you can easily repay the loan with just your profits of the next 4 years. So this way, 2,000 crores has been raised. And now we need another 5,500 crores. This is where we have method number 2. In this method, what Think would do is, since Think Green's stock price is very high, it would pledge 10% of its own shares to get a bank loan. So in this case, 12% stake worth 12,000 crores is pledged to the bank to get a loan of 6,000 crores. And once they get this loan, they would loan 5,000 crores to Think Enterprises and use the rest 1,000 crores for its expansion. So now we have 7,000 crores in total, and now we just need 500 crores extra. For this, we would just issue a bond of 500 crores and raise the money directly from the people. That's it. 7,500 crores of capital has been raised, and now we could take up a giant project and make headlines in the market. This is all by taking a loan through pledging the shares of the daughter company and then passing it on to another group company. Think can help itself grab giant projects. And now, if you look at the Adani Group, you will see something very, very similar.
Pledging shares is definitely a new norm which is used by several aggressive promoters, and Gautam Adani is no exception to that.
Adani Group has pledged its entire equity stake in the newly acquired companies.
अदानी ग्रुप ने एसीसी और अंबुजा सीमेंट दोनों में अपनी पूरी हिस्सेदारी रखी है गिरवी.
Initially, Adani Enterprises was the only company listed in the stock market. But from 2008 onwards, they started listing their companies, and now they have 7 listed companies, which are Adani Wilmar, Adani Enterprises, Adani Ports and SEZ, Adani Power, Adani Transmission, Adani Green Energy, and Adani Gas. And many of these companies also have their own subsidiaries. And then, as per the requirements of the company, they orchestrated an intricate framework of cash flow, just like the one that we learned right now. So, if you see their statements, you will see that Adani Transmission India is a subsidiary of Adani Transmission, and its financial statements for 2014-15 show that it borrowed 2,794.24 crores by pledging all immovable and movable assets of 2 transmission lines, and almost half of this money that it borrowed, that is about 1,222.97 crores, went as a loan to another listed company, and that is Adani Enterprises. Similarly, between 2013 and 2018, Adani Power was struggling with cash flow. This was because when the power project was built in Mundra, it was expected to get cheap supply of coal from Indonesia. But when Indonesia raised the price of its exported coal, Adani Power Mundra claimed that its cost of coal had risen so much that it could no longer supply power at original rates. So during this period, the company's annual reports show several instances where Adani Enterprises made loans to Adani Power directly, and it also gave out loans indirectly through its subsidiaries like Adani Infra or Kutch Power Generation. And if you look at the extent of this share pledging, you will see it in this graph, whereby from 2019 to 2020, the promoter gross pledge position actually went from 38, 37 and 28% to 58%, 54% and 50%. And this was for 3 companies which are Adani Ports, Transmission and Enterprises. So you see, this entire complexity is a permutation and combination of 2 moves, using one group company's loan eligibility to pass it on to another group company, and lastly, to direct cash flow to a troubled group company. And like we saw in a previous episode, this master plan of cash flow created a virtuous cycle for the Adanis, whereby when an Adani company wants to contest for a tender, they are able to easily raise funds. After raising funds, they bag huge infra projects, and once they do, every single news channel media house starts screaming out the progress of the Adanis. This in turn boosts investor confidence, and more people invest in Adani stock. So again, when the stock price of these companies go up, they're able to pledge the value of those stocks to get even bigger loans, which again helps them bag giant government projects. Now, is this risky? Absolutely, it's very risky, because it could lead to a vicious cycle whereby if the share value drops, the banks could sell the shares, and when such huge volumes of shares are released, the investor sentiment would go negative, and that would cause the stock to crash. And this would further lead to more selling. This is why the Hindenburg report says equity share pledges are an inherently unstable source of lending collateral, because if share prices drop, the lender can make a collateral call. If no additional collateral is available, the lender could require a forced liquidation of shares, often perpetuating a self-fulfilling cycle as stock prices move lower and selling continues. Secondly, they also point out something called the current ratio of the Adani Group. For those who don't know, current ratio is a financial indicator that measures the company's ability to pay its short-term obligations. It's basically calculated by dividing company's current assets by current liabilities. Now, if you don't understand this, here's a very simple example of the same, and if you already understood this, please skip to this timestamp. Let's start with current assets. Current assets are the assets that the company can immediately sell and generate cash. And by immediate, I mean in less than 1 year. This would include the cash, receivable amounts, inventories, etc. So in case of thinkschool, which is a made-up company, we would have 100 crores in our bank balance from previous years of profits. We would have 50 crores worth of solar panels in our inventory that could be sold. Plus, we would have clients who are yet to pay us 40 crores for our products. Plus, we would also have office spaces that could be sold to generate another 30 crores. So in total, our current assets, as in the assets that can give us instant cash, are worth 100 crores plus 50 crores plus 40 crores plus 30 crores equal to 220 crores. If this is very, very clear to you, let's come to current liabilities. Current liabilities are nothing but the amount of money that we are due to pay in the next 1 year. For example, in our imaginary company called thinkschool, we have 50 crores in loan installment to be paid this year, plus we are yet to pay our glass and silicon suppliers a total of 40 crore rupees. Plus, we have salaries to be paid, which is again going to cost us another 15 crore rupees. So in total, our current liabilities are equal to 50 crores plus 40 crores plus 15 crores, which is equal to 105 crores. So our current ratio is current assets divided by current liability, which is 220 divided by 105, which is 2.09. So this is a healthy number. Why? Because I have 220 crores worth of assets that I can immediately turn into cash, but only 110 crores worth of liabilities to be paid for. But if this ratio goes less than 1, it becomes risky. Why? Because it means that you do not have enough assets to liquidate and pay back your debt. Now in case of Think Solar, if I had 220 crores in liabilities to be paid for, but only 110 crores worth of assets that can give me cash, it's very risky, right? This is what the Hindenburg report points out with the Adani Group, whereby they stated that 5 out of the 7 Adani companies have current ratios of less than 1. In fact, the current ratios of Adani Green and Total Gas stand at 0.5 and 0.2. So yes, it is risky. But is it wrong? Absolutely not. And common sense is, if Hindenburg is smart enough to know this, ICICI and SBI are not stupid to oversee this, isn't it? And the funny thing is, Hindenburg is telling this to you in 2023, but the transactions that I showed you right now, those are dated back to 2015 and 19, so it's not new information at all, and the banks already know it, and we made a video 6 months back. So it's not new information and there's nothing too revealing about it. If this is very, very clear to you, let's look at Adani's response to this allegation. To counter the allegation regarding their debt, the group said that the growth of their EBITDA or profits before tax is 2x the growth of debt over the last 5 years. So while profits have grown at 22%, the net debt, which is the total debt of the company minus its cash, that has grown at a smaller pace of 11% annually in the last decade. So even though the value of debt is high, the debt to profit ratio has actually decreased over time. And a classic metric to understand the same would be the ratio called net debt to RR EBITDA or net debt to run rate EBITDA. In simple words, if a company has a net debt of $10 million and a run rate EBITDA of $5 million, the net debt to run rate EBITDA ratio would be 2, which is $10 million divided by $5 million. And this indicates that the company has 2 times more debt than its earnings can support. So higher the ratio, the more risky the company gets. And guess what? While most people think Adani is sinking in debt in the past 3 years, it's actually the complete opposite of it. In fact, the group has come out of debt very, very rapidly in the past 3 years. So if you look at this table, it says that net debt by RR EBITDA of less than 1 is low risk, 1 to 3 is moderate risk, 3 to 5 is high risk, and above 5 is very high risk. So if you look at this table, in 2013, Adani had a net debt to RR EBITDA of 7.6, which was very, very high risk. But by 2016, it came down to 4, which was still high risk. But now in 2022, they have brought it down to 3.2, which is a little above moderate risk. In fact, if you look at this table, 3 out of the 6 Adani companies are only in moderate risk phase. 1 of them is in low risk, 1 of them is at high risk, and green is at very high risk. But because they have a huge house of companies to balance it out, if you look at their total net debt to run rate EBITDA, it is slightly above moderate risk category. Secondly, the Adanis released this graph showing the pledged promoter shares of Adani Group that have reduced drastically from 58%, 54%, 50% and 13% to just 17%, 7%, 4% and just 3%. So you see, the risk with share pledging has actually been reduced in the past 3 years and not increased. This is the first part of both sides of the story. And like I said, I am not going to tell you anything. It's completely up to you to decide if this is right, wrong, risky or safe. If this is very, very clear to you, let's come to the last part of the episode, and that are the miscellaneous and fraud related allegations by Hindenburg report on the Adani Group. Now, for the benefit of time, I am skimming through them in groups so that it can save us time, and even the Adani Group has actually given out a common response to multiple allegations that have been put forward. So, let's go through them. The first set of allegations are regarding stock manipulations. You see guys, according to SEBI rules, once a company is listed on the stock market, its promoters or the insiders or the owners of the company, they can have a maximum of 75% stake in their own company, and it's mandatory for 25% of the shares to be held by the public. But Hindenburg implies that there are several shell companies related to the Adanis which are buying Adani shares to purposefully inflate the stock prices, eventually to increase the overall group's controlling stake to even more than 80% in some cases.
Adani Group companies have created shell companies, countries including UAE, Caribbean island and Mauritius, that led to corruption, money laundering and tax theft.
In the Hindenburg report, they claim that Adani is accused of stock price manipulation using shell companies.
Hindenburg accused Adani Group of a brazen stock manipulation and accounting fraud scheme run over decades, partly through the use of shell companies, it also said.
Now, if you look at the second table, you'll see that there are these companies like APMS, Cresta and Opal that are based out of Mauritius, and they have an unusually high percentage of portfolio in just Adani companies. So APMS has 99.4% dedicated towards Adani companies, LTS has 97% of its assets in Adani, and Opal is said to have 100% of its assets invested only in Adani companies. And all these funds are controlled by a single company called Monte Rosa Holdings, which together holds $4.5 billion worth of stake in Adani listed companies. And the Hindenburg report also points out that Adani's niece is married into a relation of the Monte Rosa company, suggesting a connection between both these transactions and the relation. Basically, it's suggesting that they're creating a series of shell companies that are buying Adani stock so that they're able to control more than 75% of the entire stock, which is against SEBI rules. And they call it stock manipulation. Now, Adani's response to this is very, very simple. They said each of the entities referenced in the queries above are public shareholders in the listed companies in the Adani portfolio, and they are not related parties of the promoters at all. And secondly, a public listed entity anyways does not have any control over who buys, sells, owns their shares, or how much volume is traded, or the source of the funds. And they say we cannot comment on the trading pattern or behavior of public shareholders. So this argument basically says that just like a public listed company is not allowed to force somebody to buy their stock, just like that, they cannot prevent anybody from buying their stock. So if a shell company buys it, a gangster buys it, or if Ganesh Prasad buys it, the Adanis have no control over it because they're a public listed company, and 25% of the shares have to be floated out to the public. And who buys them, that is not in their control. If this is very, very clear to you, let's come to the second type of allegation. This allegation is regarding the people in the Adani Group. For this, Hindenburg says Gautam Adani's younger brother, Rajesh Adani, he was accused for a diamond trading scheme in 2004 and 5, and that he was arrested twice over allegations of customs, tax evasion, forging import documentation and illegal coal imports. Similarly, Gautam Adani's brother-in-law, Samir Vora, he was accused by the DRI of being a ringleader of a diamond trading scam. But even then, the question is, how was he promoted to the executive director of the critical Adani Australia division? This is the question put forth by the Hindenburg report. And just like this, there's a detailed list of allegations on the people in Adani Group, and you can find it from the report in the description. Now, for all of this, the group put out a straightforward response saying that each of the above matters are closed and dismissed in our favor. Further, these matters have been disclosed by us in the public domain, and all our stakeholders are aware of the same. These points have been cited solely in an attempt to further the narrative of lies. Plus, the Adani team has also given sources and page numbers that you can actually refer to find these disclosures. So basically, the argument says accusation is not equal to conviction, and without conviction, these claims are baseless. And whatever proceedings have happened when they've already been revealed to the shareholders, there is nothing to be worried about. If this is very, very clear to you, let's come to the third category of allegations, which are the red flags in the management of the company. Here's where they point out that 5 Adani CFOs resigned the company in just 8 years. For this, the group responded by saying, first of all, many of the former CFOs are still a part of the organization in various other capacities, including taking on larger or key roles in the company. Secondly, they said that the organization allows and encourages development of individuals, including them taking on significantly larger roles from time to time. For example, Mr. Singh, the current CFO of Adani Enterprises Limited, he was appointed as CFO in May 2019, but has been with the organization since May 2012 itself, where he played the role as the advisor in strategic finance. Thirdly, other CFOs mentioned in the report have left to pursue individual ambitions, including their journey as entrepreneurs. For example, Mr. Amit Desai resigned as CFO of Adani Enterprises Limited to begin his journey as an entrepreneur. Similarly, Mr. B. Ravi resigned as CFO of Adani Ports for similar entrepreneurial ventures. And lastly, the Adani Group points out that the Hindenburg report conveniently fails to mention that none of these resignations have ever been made pursuant to any alleged concerns against any of the underlying companies. And each of these cited resignations and changes in CFOs have been duly disclosed from time to time as per the regulatory requirements for the public. Basically, the argument says that when most of the CFOs are still with the company, when none of them have raised any red flags themselves when they resigned, when 2 of them have gone on to become entrepreneurs, what exactly is the problem? And more importantly, when all these changes have been disclosed to the shareholders, what is wrong with that? If this is very clear to you, let's come to the 4th category of allegations, which is regarding their auditing firm.
एक गंभीर आरोप ये भी लगाया कि अडानी ग्रुप के खाते जो है वो ठीक नहीं है, उनकी अकाउंटिंग ठीक नहीं है. Shah Dhandaria is the current auditor there itself.
We are comfortable. Even Total was comfortable and is comfortable with the work done by Shah Dhandaria.
कंपनी में बहुत ही छोटे ऑडिटर्स अपॉइंट कर रखे हैं जिनकी इतनी क्षमता नहीं कि इतनी बड़ी ऑडिट कर पाए.
Okay, we should not impugn people because they're small firm, they pay rent, because they are sitting in an office where before we had full leasing. Now our office is Adani Corporate House.
Here, Hindenburg says that the independent audit for Adani Enterprises and Adani Total Gas is actually a very tiny firm that reported having only 4 partners and 11 employees. This company's name goes by the name Shah Dhandaria, and of the partners featured on its archived team page, they found that 3 of these partners were in their 20s with hardly the level of experience or seniority that is needed to scrutinize such big and powerful companies. For this, the Adani Group responded by saying all these auditors have been duly certified and qualified by the relevant statutory bodies who are responsible to determine these benchmarks. Secondly, all auditors have been appointed in compliance with the applicable law, and the company's public documents clearly disclose Shah Dhandaria as their auditor to all regulators and stakeholders. So it's quite questionable as to what exactly is wrong with this. In fact, the Adani Group points out that the Hindenburg report had done a terrible thing by disregarding the personal privacy and safety of these people, because they literally published private and personal information, including the pictures of government IDs, without any consent or the attempt to safeguard the identities of the people in question. So it's not an attack on the company anymore, but on the individuals and their families, and that too with no proven wrongdoings. This is the story of the allegations by Hindenburg, the concepts and numbers behind them, Adani Group's response, the concepts, numbers and proofs behind the rebuttal. And now, it's completely up to you to decide who's right and who is wrong. And my only opinion in this matter is that we should wait for a reputed body like SEBI or the courts of India to actually come to a conclusion as to whether something really went wrong with the Adani Group or not. Until then, all of our opinions are completely baseless. Meanwhile, please find all the study materials attached in the description. That's all from my side for today, guys. If you learned something valuable, please make sure to hit the like button in order to make YouTube Baba happy. And for more such insightful business and political case studies, please subscribe to our channel. Thank you so much for watching. I will see you in the next one. Bye bye.